Have you ever considered how the value of your currency impacts everything from the cost of your favorite imported goods to your next overseas vacation? It is a complex dance on the global economic stage, and behind the scenes, there is a crucial player working to keep the rhythm steady. Central banks primarily stabilize exchange rates through a combination of foreign exchange market interventions, adjusting domestic interest rates, and, in some cases, implementing capital controls. Their goal is to prevent excessive volatility that could harm a nation's economy. When a central bank intervenes in the foreign exchange market, it either buys or sells foreign currency using its reserves. For example, if the domestic currency is depreciating too rapidly, the central bank might sell some of its foreign currency holdings, like United States dollars or euros, to buy its own currency. This increases the demand for the domestic currency and reduces its supply in the market, thereby strengthening its value. Conversely, if the domestic currency is appreciating too much, the central bank might sell its own currency to buy foreign currency. Changes in interest rates also play a significant role. Higher domestic interest rates can attract foreign capital seeking better returns, increasing demand for the domestic currency and causing it to appreciate. Lower interest rates can have the opposite effect. Capital controls are more direct measures that restrict the inflow or outflow of foreign capital, directly influencing currency supply and demand. To conduct a foreign exchange intervention, a central bank needs substantial foreign currency reserves. These reserves allow it to participate as a large buyer or seller in the currency market, making its actions impactful. When a central bank decides to raise interest rates, it typically does so by adjusting its policy rate, such as the federal funds rate in the United States. This change then ripples through the banking system, affecting all other interest rates and influencing international capital movements. These actions are often part of a broader monetary policy strategy aimed at achieving overall economic stability, including price stability and employment goals. Many countries operate under what is known as a managed float or dirty float exchange rate regime. This means their currency's value is largely determined by market forces, but the central bank reserves the right to intervene occasionally to smooth out excessive fluctuations. A core challenge for central banks is navigating the impossible trinity, also known as the trilemma. This concept states that a country cannot simultaneously have a fixed exchange rate, free capital movement, and an independent monetary policy. Central banks must choose two out of these three, which significantly shapes their approach to exchange rate management. Understanding this trade-off is key to comprehending global monetary strategy. By strategically deploying tools like foreign exchange interventions, interest rate adjustments, and sometimes capital controls, central banks work diligently to maintain stable exchange rates. This stability is not just an abstract economic concept. It directly supports international trade, fosters investor confidence, helps control inflation, and ultimately contributes to the overall health and predictability of an economy. These deliberate actions ensure a smoother economic journey for everyone.